Today, we are examining 10 structural developments shaping digital assets. As always, the objective is not to predict prices. The objective is to understand risk, evaluate probability-weighted scenarios, and identify the institutional signals that matter most. Let's dive in. Lawmakers raced to pass Clarity Act before Congressional deadline. Think of the Clarity Act as a potential reduction in one of the largest barriers preventing institutional participation: legal uncertainty. Right now, many banks, asset managers, and custodians remain interested in digital assets, but face internal compliance hurdles due to overlapping regulatory interpretations. From an MBA perspective, clearer rules could lower transaction friction and reduce regulatory ambiguity, making it easier for institutions to evaluate blockchain-related products and services. If implementation is effective, it may remove one of the key obstacles that has historically slowed institutional adoption. But from a computer engineering and regulatory design perspective, the risk isn't whether rules arrive. It's whether they arrive well designed. Complex technology legislation written under deadline pressure often produces unintended consequences. Compliance requirements built for large financial institutions can accidentally create barriers for startups and open source developers. Historically, innovation tends to migrate towards jurisdictions with more predictable regulatory environments. Investors should pay close attention not just to whether the bill passes, but to whether the final language encourages innovation or concentrates market power among a small number of well-capitalized incumbents. And speaking of new forms of market participation, what happens when the next customer entering crypto markets isn't a human at all? Coinbase introduces dedicated institutional accounts for artificial intelligence agents. On the surface, this may sound experimental, but the long-term implication is significant. We may be witnessing the early infrastructure for machine-to-machine commerce. Imagine AI systems purchasing computing resources, data feeds, API access, or research subscriptions without requiring manual approval for every transaction. By combining stablecoins, programmable payments, and isolated financial accounts, platforms can begin testing economic activity where software becomes an active participant rather than just a tool. If adoption expands, this could create entirely new transaction flows that traditional payment systems were never designed to support. From a certified fraud examiner's perspective, however, autonomous financial agents introduce an entirely new category of operational risk. History shows that automation often scales mistakes faster than humans can react. A flawed prompt, compromised API, logic error, or a security vulnerability could cause an AI agent to deploy funds in unintended ways. Bad actors will likely focus heavily on these systems because exploiting machine-speed decision-making can create opportunities before human oversight intervenes. The key institutional question is not whether AI agents can transact, but whether adequate controls exist when something inevitably goes wrong. Now, if AI agents represent a new participant in financial markets, the next story focuses on rebuilding the infrastructure those markets operate on. Financial institutions forecast significant capital efficiency gains through asset tokenization. When institutions like Franklin Templeton and BNP Paribas discuss tokenization, they're not talking about speculative crypto trading. They're talking about modernizing financial infrastructure. Today, moving assets, collateral, and securities across multiple jurisdictions often requires layers of intermediaries, reconciliation processes, and settlement delays. From an MBA perspective, reducing those frictions can improve capital efficiency and free up liquidity that would otherwise remain idle. If tokenization adoption continues, institutions may gain faster settlement, lower operational costs, and improved transparency across asset life cycles. But investors should be careful not to confuse tokenization pilots with true ecosystem transformation. Many large institutions are building private permissioned networks rather than using open public infrastructure. That creates a familiar fragmentation problem. If every bank develops its own walled garden, assets may still face interoperability challenges similar to those found in traditional finance today. The institutional signal to watch isn't whether tokenization projects launch. It's whether assets can move seamlessly across organizations without creating new silos. And while institutions are trying to make assets move more efficiently, another group is focused on something entirely different, making transactions harder to see. Infrastructure provider acquires protocol team to deploy native Solana privacy layer. Privacy remains one of the largest barriers, preventing many commercial applications from moving fully on-chain. Businesses often cannot expose sensitive transaction data, supplier relationships, or settlement information on public ledgers. By integrating zero-knowledge technology directly into Solana infrastructure, developers may be able to offer confidentiality without sacrificing scalability. If successful, this could expand blockchain adoption into areas where transparency has historically been a competitive disadvantage. From a computer engineering perspective, however, concentration risk deserves attention. When critical privacy infrastructure becomes dependent on a small number of providers, ecosystems may introduce new centralization points. Additionally, compliance-oriented privacy systems often create governance questions regarding who controls access mechanisms and under what circumstances information can be revealed. Investors should evaluate not only to the technology itself, but also the governance structures surrounding it. That debate between privacy and compliance doesn't stop with Solana. In fact, the next story pushes the trade-off even further. StarkWare and Sui launched compliance-oriented privacy systems for confidential transfers. For years, blockchain privacy presented regulators and enterprises with an all-or-nothing choice. StarkWare and Sui are attempting a middle ground solution by allowing transaction details to remain private while preserving selective auditability. Organizations may be able to protect commercially sensitive information without sacrificing compliance obligations. For regulated industries, that could remove one of the biggest operational barriers to blockchain adoption. From a certified fraud examiner's perspective, selective privacy introduces an entirely new layer of governance risk. Whether special access rights, audit keys, or privileged visibility mechanisms exist, investors must ask who controls them and what safeguards exist against misuse. History shows that governance vulnerabilities often become more significant than technological vulnerabilities. The critical question is whether these systems can balance privacy and oversight without creating excessive concentration of power. If privacy is one of the building blocks of institutional finance, credit markets are another. And that's where the next development comes into play. Decentralized credit network secures major capital to expand custom lending infrastructure. Morpho's funding round highlights a broader trend occurring across digital assets. Venture capital increasingly targeting infrastructure rather than consumer-facing applications. Customizable lending frameworks allow institutions to create specialized credit markets with tailored risk controls, collateral requirements, and compliance standards. From an MBA perspective, modular infrastructure can significantly reduce development costs and accelerate deployment timelines. If adoption grows, these systems could become foundational components of future digital credit markets. The challenge is that flexibility often introduces complexity. Customized lending pools can fragment liquidity and make risk assessment more difficult. During periods of market stress, Seemingly isolated pools may reveal hidden interconnectedness. Additionally, concentrated venture ownership can create governance concerns if a small group of stakeholders gain disproportionate influence over protocol direction. Investors should monitor both technical adoption and governance concentration simultaneously. Of course, none of that lending infrastructure matters if the underlying code isn't secure. And the next story is a reminder of exactly that. Machine intelligence discovers critical vulnerability with zero-knowledge protocol layer. The most important aspect of this story may not be the vulnerability itself, but how it was discovered. As blockchain infrastructure becomes increasingly complex, machine-assisted auditing could become an essential security tool. AI systems can analyze massive code bases and identify patterns that might escape traditional review processes. If these capabilities continue improving, the industry may gain a powerful new layer of defense against future vulnerabilities. However, this incident also highlights a difficult reality about advanced cryptographic systems. Complexity can conceal vulnerabilities for years before discovery. In previously focused environments, verifying whether historical exploitation occurred may be challenging or impossible. Investors should pay close attention to how teams communicate vulnerabilities, coordinate upgrades, and respond to crises. Governance quality often becomes most visible during moments of stress. Security is one challenge. Demonstrating real-world business value is another. That's where the next development becomes particularly interesting. Major consumer electronics brand pilots ad network on custom layer 2 blockchain. One of the strongest long-term adoption signals is when companies use blockchain technology to solve operational problems rather than launch speculative products. By testing blockchain infrastructure within advertising systems, large enterprises can evaluate whether smart contracts improve transparency, automate verification, and reduce fraud. If these pilots produce measurable efficiency gains, blockchain adoption could gradually expand into industries that have little connection to crypto speculation. At the same time, investors should distinguish between blockchain usage and value accrual. Many enterprises prefer proprietary environments that prioritize operational control over decentralization. From a strategic perspective, a growing number of isolated corporate blockchains could fragment developer resources and ecosystem activity. Consumer privacy concerns may also emerge if users perceive blockchain-based tracking systems as intrusive. And while corporations are experimenting with new operating models, decentralized organizations are still trying to figure out how to govern themselves. Decentralized autonomous organization governance model faces friction over corporate buyout proposal. Supporters of decentralized governance view situations like this as proof that blockchain-based organizations can handle complex corporate decisions transparently. Traditional acquisitions often involve closed doors negotiations and lengthy approval processes. Market-based governance mechanisms attempt to incorporate real-time incentives directly into decision-making. If effective, these models could eventually create more transparent and efficient organizational structures. From a certified fraud examiner's perspective, however, governance systems must be evaluated under adversarial conditions. When significant economic value is involved, wealthy participants may possess outsized influence over outcomes. Short-term market incentives can also conflict with long-term organizational objectives. The true test of governance is not how systems perform during consensus, but how they perform during conflict. Investors should monitor participation levels, voting concentration, and incentive alignment rather than focusing solely on headline outcomes. If governance challenges seem difficult today, the final story examines a technological challenge that could affect the entire industry decades into the future. Core research team outline roadmap for post-quantum encryption transition. One hallmark of mature infrastructure is planning for risks before they become immediate threats. By developing quantum-resistant roadmaps years in advance, researchers are attempting to ensure that blockchain networks remain secure, even as computing capabilities evolve. From a risk management perspective, proactive preparation reduces the probability of future emergency responses and provides valuable time for testing and standardization. But from a computer engineering perspective, upgrading cryptographic foundations is among the most complex tasks a distributed network can undertake. Every validator, wallet provider, developer, and infrastructure operator may need to coordinate changes over extended periods of time. Larger signatures, migration complexity, and ecosystem coordination introduce significant operational challenges. The risk isn't simply technological, it is organizational. Successfully executing a transition of this scale will require years of alignment across globally distributed stakeholders. Taken individually, each of these stories may seem unrelated, but collectively they reveal the same underlying trend. Digital assets are increasingly being shaped by infrastructure decisions, governance frameworks, compliance requirements, and institutional adoption pathways. As always, focus less on headlines and more on the structural signals developing underneath them. Those signals often determine where capital ultimately flows long before the broader market notices. Remember, you can find my write-up on Substack at AssetLens. See you in the next video. Thank you.